Welcome to Inside the Deal. I'm Suzanne Stevens. With me today is Robert Claassen. Robert chairs the Derivatives and Structured Products Group at Paul Hastings. Robert, we're here to talk about regulation and transparency in the credit default swap market.
Right.
A very hot topic
yes,
now, and
exactly.
one that is evolving. You have some questions and some concerns about formal regulatory oversight of the market. What are those?
Well, I think it's clear, and I think that there's a consensus within the industry that some regulation is necessary in this market. There's significant counterparty risk that is causing inefficiencies, and also there's a lack of transparency that I think could be fixed and could be solved. The real question, though, is if there's too much regulation, or if all over-the-counter derivatives are forced onto the exchange, which is some of the talk in Washington. I think the effect of that could be to drive the OTC or over-the-counter derivatives market offshore.
Does that concern, though, lose a little steam considering how global this crisis has become? Where would that market go?
Well, a number of jurisdictions. There are a number of credit default swaps currently booked in London and in Asia, and it's possible to do the transactions even in places like the Cayman Islands. So I think you may end up seeing the over-the-counter market go offshore if we are too heavy-handed in our regulation here in the States.
The idea of a clearinghouse has really gained momentum.
Yes.
Seems like we're headed in that direction. A lot of support for that. What are your thoughts on the idea of a clearinghouse?
Yeah, I think a clearinghouse could be a very positive thing for the market. Right now, one of the principal concerns that market participants have is the fact that there's significant risk to their counterparty in entering into these transactions. The principal advantage of an exchange or a central clearinghouse is that they will be the credit counterparty in all these transactions, and that would alleviate the credit risk that currently permeates the market.
Okay, here's the big question. Had there been a clearinghouse in effect in 2007 or late 2006, as this market was really growing, could it have averted, lessened the meltdown that we've seen this year?
Yes, I think there's no question that it could have. The real question, though, that I have is how much of the market can potentially be transferred to a clearinghouse. I think it's a very positive result if you can get there. The real challenge is that a number of these contracts are highly specialized and negotiated, and it's not easy to transform those into the uniform contracts that are necessary for a clearinghouse to be able to clear them.
So it's wrong to assume that all the players would take part if a central clearinghouse or a couple of clearinghouses were established?
I think so. It's hard to say at this point how it will ultimately end up, but I do think that it's going to be very difficult to create clearinghouse rules which are able to clear the entire market. I think there's going to be a significant portion of the market that's too specialized and too customized to be able to work through what are necessarily going to have to be more uniform clearinghouse rules.
How does a clearinghouse, though, in the absence of some type of federal oversight, really guard against the meltdown, that we've seen this year? There's no teeth there, it seems like, if there's not a regulatory agency that's kind of overseeing it.
Well, sure. I think you need a regulatory agency to oversee it. I think the real question is which agency. Historically, it's been the SEC or the CFTC that's regulated clearinghouses in the United States. What's interesting with the New York proposal is it's actually going to be a New York state-chartered bank, which would be the clearing agency, which potentially could provide more flexibility and clear a larger percentage of the market. So I think it could be a very positive thing, and having a regulator like the Federal Reserve Board with a balance sheet could potentially alleviate a lot of market risk.
We're talking a lot about regulation. We have a new president coming in, a new Congress coming in January.
Right.
Have you heard much from President Obama? Has he been talking about this, or what are your expectations?
At this point, I think it's all speculation. I will say, however, that I'm very impressed with his selection of his economic team, and in particular, I think Tim Geithner, who has been involved in the New York clearinghouse proposal, I think may favor that type of a clearing system and that type of a regulation. So that may be an indication that the Federal Reserve Board will be the ultimate regulator.
We saw the CDS market grow 80-some% in 2007. That slowed a bit this year. What's your best guess as to where we'll be a year from now?
Well, look, it's hard to say. I think a lot of the capitalization issues facing a number of financial institutions have impacted the market for credit derivatives, certainly, and and I think that will be a limiting factor. However, I believe that if we get this clearinghouse done properly and done right, that'll enable more participants to participate and could potentially actually result in, continued growth of the CDS market. But hard to speculate.
How long will it take to get a clearinghouse model right, do you think?
Well,
what's a reasonable
there is talk that we could have something in place by the end of the year. I would be very surprised, however, if they were able to clear a significant portion of the CDS market by the end of the year.
Robert Claassen with Paul Hastings, thanks so much for stopping by.
Great, thank you very much.
I'm Suzanne Stevens. Thanks for watching Inside the Deal.